I analyzed the portfolios of 90 hedge fund billionaires, which together manage over $1.1 trillion. I spent weeks analyzing what successful investors like Stanley Druckenmiller, Bill Ackman, or Carl Icahn are buying. Most of them beat the market consistently as they posted insane returns for 2023. For example, Pat Dorsey returned 44%, Stanley Druckenmiller 46%, while Chase Coleman at Tiger Global returned 52%. And today, we'll see what stock ideas we can steal from these billionaires so that we can also beat the market. But before we get there, we need to start with the elephant in the room. The poster child of this market rally, Nvidia. Did these billionaires buy the stock before Nvidia's 75% return in 2024? And this might surprise you, but they did not. In spite of the fact that they have many more resources than we have, at the beginning of the year only 9 investors were holding Nvidia with an average weight of 4.3%. The investor that has most of his portfolio in Nvidia is Stanley Druckenmiller with 16% weight. It looks like these billionaires were not rushing to own Nvidia at these all-time highs. So let's see the top 10 stocks that these investors are rushing to own. And we'll later see that these billionaires clearly love the number one stock, which is present in 79% of their portfolios. But before we get there, let's start with number 10, owned by 19% of the investors. On average, it has a weight of 2.6%, and the stock has done very well in 2024 as it already returned 17%. It's more impressive considering that this is the stock of a bank that activates in commercial, consumer, and investment banking and has more than $938 billion in loans. This stock is Wells Fargo, and it recently became the most expensive that it has been in the last 2 years after they beat expectations for earnings in their last quarter. Next, at number 9, we have a stock that's red hot, growing more than 30% in 2024 because of the insane opportunities for AI growth. This one is a chip stock, and although the chip market is competitive, 20% of investors own Taiwan Semiconductor at the beginning of 2024. However, the stake was on average 2% of their portfolios, so this isn't a crucial position for them. Still, the company surpassed estimates in the last quarter, as some experts argue that Taiwan Semiconductor is one of the most important companies in the world.
Taiwan Semi is, I think, one of the 5 most important companies in the world. You can name almost any other company and say if that company shut down for 30 days, it might be a little uncomfortable for some of their employees. Taiwan Semi stops for 1 day, the entire global situation would be in serious trouble.
Next, at number 8, we have a leader in the healthcare space, which is also owned by 20% of the investors with an average portfolio weight of 2.2%. Even if the company is expected to grow 8% in both 2024 and 2025, the stock did absolutely nothing in the last 2 years as it remains flat. The stock is United Health Group, which had a rough couple of weeks after one of its divisions was hacked, which disrupted pharmacies and hospitals throughout the US. As a result, the stock is now cheap with a PE ratio around 17.6 times, which is low compared to its historical multiples. At number 7, we have a stock owned by 23% of investors with an average portfolio weight of 4.6%. This is a payment processing company that's expected to grow more than 12% for both 2024 and 2025. As a result, the stock performed very well with a return around 13% in 2024. The stock is MasterCard, which posted better than expected earnings because consumer spending remained strong in the last quarters. However, as a result, the stock became pricey. But considering that MasterCard activates in an oligopolistic industry, a decrease in the multiple is not guaranteed. And speaking of oligopolistic industries, the other competitor for MasterCard is Visa, which sits at number 6, and it is owned by 28% of the investors with an average weight of 4.7%. Visa stock is also at an all-time high with a return of 10% in 2024. Still, Visa remains the global leader with more cardholders, purchase volumes, and outstanding balances compared to MasterCard. However, Visa is significantly cheaper than MasterCard on a price-to-earnings basis as it trades around 27 times compared to MasterCard's 33 times. The reason might be that Visa is only expected to grow around 10% in 2024 and 2025 compared to 12% for MasterCard. Still, if you want to pick a company over the other, it's most a matter of preferences, and I believe that having exposure to any of them is a good thing. And I'm not the only one arguing this.
I was asked by a student, what's the single best business in the world? I said, if you could own a royalty on people spending money, like Visa or MasterCard, it's the greatest business in the world. And if that ever became a public company, you want to buy that company.
Next, at number 5, is a stock owned by 30% of investors with an average weight of 6.3%. The stock sits near its all-time highs, as it returned 15% in 2024. Moreover, considering the historical multiple, the stock seems cheap with a P/E ratio around 42 times. And even when considering the earnings growth expected, it still seems cheap.
The PEG ratio, again, mentioned it earlier, that's the price to earnings ratio versus the long-term growth rate, is 1.5. That is very attractive for a stock.
The stock is Amazon, and the company posted solid financial results, beating Wall Street estimates. The revenue growth is expected to be around 12% for both 2024 and 2025, with the strongest growth coming from its cloud and ad businesses. Next, at number 4, we have a stock owned by 31% of investors with an average weight of 6%. This stock had the perfect 2023, as it had one of the strongest bull runs with a return of more than 180%. This is unreal for a mega cap worth over $1 trillion. But it was all possible because the company shifted its investment focus from the metaverse to AI. The stock is obviously Meta, and billionaires seem to love it.
We do like what it is doing, and the fact that Mark Zuckerberg is now prioritizing artificial intelligence as opposed to the metaverse.
The recent financial results have been nothing short of spectacular, with impressive growth and phenomenal margin expansion. The operating margin hit a high of 44%, which is exactly what investors want to see going forward. Still, in spite of the recent run, because the earnings are expected to grow, Meta is still a cheap stock. In the context of the Magnificent Seven, Meta is the second cheapest stock, only after Google, so the rally in Meta might still continue. Now, let's talk about the third position, which is owned by 39% of these billionaire investors with an average weight of 8.3%. This is the biggest weight out of all the stocks that we'll cover. And the reason is because the third stock offers diversification. And not only that, but it also comes with a relatively passive strategy since the investing decisions are made by Warren Buffett. Obviously, the third stock is Berkshire Hathaway, which is a diversified holding company that activates in transportation, insurance, energy generation, and other sectors. The stock had a strong start of the year, already returning 15% in 2024. And now, let's get into the most owned stocks, and we're gonna start with number 2, which appears in 40% of the portfolios with an average weight of 6.8%. This was another one of these stocks that just dominated the market in 2023 with a return of 65%. The trend continued with an 11% return in 2024. This is impressive, especially for a large cap worth more than $3 trillion. The stock is obviously Microsoft, which has been on a phenomenal growth trajectory, beating estimates for both revenue and earnings per share. Revenue grew incredibly, while the operating margin remained consistently above 40%. But besides Microsoft's core business, investors are also interested in Microsoft's investments in AI. After investing a huge amount in OpenAI, Microsoft became a leader in artificial intelligence. Now, it plans to use AI to grow its overall business in areas like cloud or cybersecurity. As a result, Microsoft is the third most expensive stock in the Magnificent Seven, so be aware of the valuation before buying. And now, we're finally at the number 1 stock, owned by 79% of these investors with an average weight of 4.5%. This is by far the most beloved stock by billionaire investors, and it seems like a must-own. The stock grew 60% in 2023 and is now up a modest 5% in 2024, but that's expected for a large cap worth almost $2 trillion. And this stock is obviously the other big AI player, Google. The stock recently jumped on rumors that Apple is interested in letting Google's Gemini power all its AI functions for the iPhone. Apple licensing Gemini would be a massive announcement that would confirm that Google is not far behind OpenAI. In fact, that's what some billionaires believe, as for instance Bill Ackman has Google as the only AI investment in his portfolio.
And our view, based on work we had done, is that actually Google was sort of neck and neck, if not ahead of OpenAI in terms of their business progress.
And again, going into valuation, Google is not only much cheaper than Microsoft, it is also the cheapest stock out of the Magnificent Seven, both in terms of enterprise value divided by the next 2 months EBITDA, as well as in terms of price to earnings ratio. And now, to sum up, what can we learn after studying the portfolios of these 90 billionaires? Besides the fact that they love Google, there's another important lesson that we should take with us, and that is that these investors are forced to run diversified portfolios. Only 19 of them have 10 or less stocks in their portfolio, while the average billionaire owns 52 stocks. But we don't need to follow 52 stocks to make money. And it's not me saying it.
If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money.
So it is clear that these funds play by a different set of rules, as they don't look to create wealth, but rather to protect their capital. If at the beginning I said that they have more resources than us retail investors, here's where we have the upper hand. Because for retail investors, it's totally fine to have a very concentrated portfolio. And if we can endure the volatility, we can take risky bets that would be impossible for these billionaires. So let's take advantage of our strengths and let's create quality concentrated portfolios. And if you want to start right now, you can do so by watching this next video.